Hello, everyone. I'm Sharon Garcia, Marketing Manager here at Mazars in the U.S., and I'd like to thank you for attending our webinar. Today, we will be presenting New York Pass-Through Entity Tax, a potential opportunity to save federal taxes, which will be led by Harold Etch, Tony Mazzacca, and Harry Johnson. Before we begin, I'd like to review a few housekeeping items. First, we encourage you to ask questions. To do so, please send them to us using the Q&A box on the lower left-hand side of your screen. We will try to answer all of your questions during the webinar, but if a fuller answer is needed or if we run out of time, your question will be answered after the webinar via email. Second, to earn the available 1 CPE credit during today's webinar, you must listen to at least 50 minutes of the presentation and answer at least 3 polling questions. The polling questions are a series of questions meant to confirm that you are actively attending this webinar. Please note that you must be logged in individually to receive credit for today's webinar. If you are attending as a group, only the individual who is logged in will receive credit. If you've completed the requirements, your certificate will be available for download at the end of the webinar. Instructions on how to download your certificate will be displayed on the screen at the end of the presentation, so please stay on the line. Lastly, you can download a copy of today's presentation from the green Resources button at the bottom of your screen. Here, you will also find our webinar Frequently Asked Questions, a document which offers some basic troubleshooting information and other useful tips. Again, this can be found under the green Resources button at the bottom of your screen. Now, thank you once again for joining, and I'll hand it over to Harold.
Thank you, Sean, and welcome everyone. We're truly excited to bring you all of the details of what could really be a very significant federal tax savings opportunity as a result of New York's enactment of the pass-through entity tax. This is really hot off the press in that many of us tax professionals were waiting for New York State to issue guidance with respect to the details of the PTET, and those were just issued in the last 2 weeks. So in today's presentation, we are going to bring you an in-depth analysis of the PTET, how to make the election, how to compute the tax, and so forth. By way of introduction, I'm Harold Hecht. I'm a managing director, and I lead the state and local tax practice for Mazars in the U.S. Joining me today are Tony Mazzacca, who is a federal tax partner in our New York office specializing in financial services, and Harry Johnson, senior manager in our state and local tax group in our Pennsylvania office. Here is the agenda for today's presentation. Tony is going to kick this off for us by giving all of us some background on federal law and applicable provisions. I will provide you with a comprehensive list of all of the states that, as of now, have enacted similar pass-through provisions that might be of interest. Then Harry is going to give you some of the nitty-gritty with respect to what entities qualify to make the election, when the election is due, how you make the election, and when payments can be remitted. I will then share with you some of the deeper concepts of how the computation varies for partnerships and S corporations. And finally, we'll summarize what factors need to be considered in whether to elect or not. Tony will also, in her presentation, give you a very high-level summary of the New York provisions, and then Harry and I will bring you all of the significant details. So without further ado, I will pass it on to Tony to give you the background on the federal tax provisions. Tony?
Thank you, Harold. Good afternoon and happy September 15th to everyone. As Harold mentioned, I'm going to provide you with a brief summary of the federal impact of the New York pass-through entity level tax. So when the Tax Cuts and Jobs Act was issued in 2017. As many of us know, it contains a provision that limits individuals' itemized deduction for state and local taxes paid to $10,000 a year. This is known as the SALT limitation. This limitation applies to tax years after December 31st, 2017 and before January 1st, 2026. This limitation has impacted individual taxpayers' federal tax liability, especially in states with high tax rates, such as New York. In response to that, on November 9th of 2020, the IRS issued Notice 2020-75, which states that proposed regs will be issued on the deductibility of state and local tax payments made through pass-through entities. These payments are referred to as specified income tax payments. So if a partnership or an S-Corp makes a specified income tax payment during the year, the partnership or S-Corp is allowed a deduction for the specified income tax payment in computing its overall taxable income for the taxable year in which the payment is made. And these payments are not taken into account in applying the SALT deduction limitation to any individual who is a partner in the partnership or a shareholder of the S-Corporation. Therefore, what happens is when the partnership or S-Corp makes the income tax payment to the local jurisdiction, and the expense would then be allocated to each partner or shareholder, similar to any other item of income or deduction on each partner or shareholder's individual K-1 as a pro rata share of non-separately stated income or loss. And it would then be deducted on each individual's Form 1040. Typically, partnership income flows onto Schedule E of the Form 1040, which generally does not limit expenses, versus if the individual taxpayer pays the state and local taxes themselves, this is reported on Schedule A, which is now, as we know, limited to $10,000 a year. The New York Budget Act includes a new law that provides a workaround to the federal law, and this puts the limit on an individual's, which puts the limit on the individual's federal income tax return. In addition to New York, there are a handful of states that have also adopted pass-through entity tax regimes and are intended to bypass the $10,000 SALT limitation. And again, this is done by imposing the tax directly at the pass-through entity level and correspondingly providing the owners of these pass-through entities with a credit or deduction that would fully or partially mitigate the additional expense at the federal level. I think Harold and I were talking before the call, and we're just trying to determine how many states out there right now are contemplating this entity level tax, and we think it's about half a dozen at the moment, if I'm not mistaken, right, Harold?
Yes. And Tony, I think we also were speaking about the intriguing issues surrounding the proposals that Congress is contemplating right now with respect to various federal tax provisions. And one of the items for sure that seems to be hotly debated is the SALT limit. And the latest I saw was that there's a possibility that the Democrats might be offering something along the lines of a 2-year deferral of the SALT limitation that might be part and parcel of the $3.5 trillion budget package that is being contemplated. But clearly at this point seems like there's no consensus between the progressives and the more moderate Democrats as to how to proceed.
Yeah, that's right. That's right. So we'll have to wait and see on that one. So the concept of the workaround is, like I mentioned, this is an entity level specific tax that is made by the pass-through entities, such as a partnership or an S-Corp. The payment of the tax must be made by the entity, and then it's passed through as a deduction to its members. Because the deduction is an entity level tax, it doesn't fall under the limiting law that we just mentioned. And to make members whole for the cash paid by the entity, the states provide a credit to the members on their personal state income tax returns. And this credit is what flows up to each individual partner or shareholder's K-1. There's no cash out of pocket between the entity and its members, and there is a tax deduction for the members that avoids the $10,000 limitation. And the criteria that must be met in order to make this election is that it must be made by an eligible partnership or S Corp. And Harry's going to go into further details later on in the presentation. The election must be made annually online by an authorized person and on or before the due dates of the first mandatory estimated PTET payment. The first mandatory estimated PTET payment is March 15th for a calendar year taxpayer. However, for 2021 only, this deadline has been extended to October 15th of 2021. And similar to how corporations make their estimated payments, these PTET payments must be made online in quarterly payments due March 15th, June 15th, September 15th, and December 15th in the calendar year prior to the year in which the due date of the PTET return falls. Also for 2021, the requirement to make these PTET estimated payments has been waived, so the IRS is really availing itself to allow taxpayers to take advantage of this new provision. The pass-through entity tax return is a separate return outside the forms 1065 or 1120S's that the partnerships or S Corps file. And again, it's online, it's filed online, as I mentioned. So for calendar year taxpayers, it would be due March 15th, same deadlines as the forms 1065 and 1120S's. And there are also 6-month extensions available similar to all other income tax returns. Pass-through entity tax is imposed on pass-through entity taxable income, which flows through to the direct members of the pass-through entity who are subject to New York personal income tax. And this would include guaranteed payments. So just to illustrate this, if you have a married couple that files jointly and one is a partner in a partnership and the other is a W-2 employee, and the partnership chooses to make this election and pay the state tax on behalf of its partners at the entity level, these taxes would not be limited on the individual's 1040. This therefore frees up the limitation to the other spouse who continues to be limited to the $10,000 SALT limitation. This helps maximize the deductions and the couple would be allowed to take. And again, it's extremely impactful in states with high income tax rates. And just to reiterate what Harold just said, you know, our Democratic leaders just have not reached a consensus on this item yet in terms of what they're going to do with the $10,000 cap on these deductions. We just have to wait and see what happens. And so now I'm going to hand it back to Harold to go into more details on the state issues related to New York pass-through entity tax.
Thanks, Tony. But before we do that, to Sean for
for the polling question. Yeah, thank you, Harold. So the first polling question of the webinar is up on your screen, and it's asking, what type of company do you work for? Accounting, law firm, financial services entity, real estate owner, manufacturing or distribution, or other. Please make your selection now and be sure to click the submit button to get credit for your answer. We're just going to give it a few more seconds. Be sure to click the submit button to get credit. Okay, let's take a look at the results. It looks like the majority, 59.5%, are from accounting firms. Back to you, Harold.
Thank you, Sean. So as Tony mentioned earlier, there are quite a number of states that have either enacted pass-through entity taxes that are similar to New York's PTET, or are contemplating that through legislation. As you can see here, there are already quite a number of states that have jumped on the workaround bandwagon, and most recently, both California and Illinois enacted legislation that was signed by their governors that enacted exactly the same type of PTET taxes as New York. California clearly very significant in that it's such a high tax jurisdiction. The one thing to note about these workarounds is that they're not uniform and they have various effective dates, and taxpayers should consider the specific structure that they have, the income source to those jurisdictions, and the actual mechanics with respect to computing these pass-through entity taxes before deciding whether to elect or not elect. Virtually all of them are elected. Connecticut is one prime example of a pass-through entity tax where it's mandatory, where all pass-through entities are required in Connecticut to file the pass-through entity tax. Sean, I believe we have another polling question. So the next polling question is, what do you think will be the most likely disposition of the 10,000 SALT deduction limitation and the potential tax bill coming out of Congress? Do you believe that the deduction will remain the same at 10,000? Will the deduction be increased, or will the limitation be eliminated? Please answer one of the three in order to receive your CPE credit.
Thanks, Harold.
You're welcome, Sean.
We're just going to give it a few more seconds. Be sure to click submit for credit. Okay, let's take a look at the results. 47.9% said that they think the deduction will remain the same at $10,000.
This is really intellectually a very intriguing issue because it appears that the sticking point is that progressives believe that the lifting of the 10,000 limitation will disproportionately benefit the wealthier taxpayers. And of course, the moderates are concerned that the 10,000 limitation is causing a world full of hurt to some of the states like New York, California, and New Jersey that have higher tax rates. So it's almost like an intriguing philosophical divide between the two sides that will be really interesting to see how it plays out in Congress. I guess ultimately, when you step back for a moment, these pass-through entity taxes, to some degree, probably in and of themselves, may be disproportionately beneficial to wealthier people. And ultimately, when it comes to the typical wage earner that won't be able to avail themselves of these types of workarounds, they seem to be the ones that could potentially be hurt. But again, hopefully details will be forthcoming shortly from Congress. And at this point, Harry is going to take you through some of the deeper details on which entities qualify, how you make the election, and when to make it. So, Harry, on to you.
Thanks, Harold. Yeah, I'm just going to provide some more detail on which entities qualify, when the election is due, and how the pass-through entity tax election is made. As Tony previously indicated, eligible entities are New York S corporations and entities taxed as partnerships. An eligible S corporation is defined as any New York S corporation, including an LLC, treated as an S corporation for New York and federal income tax purposes, as defined by Section 208.1-A, and that is subject to the fixed dollar minimum tax under Section 209. So I just want to make the point that a federal S corporation defaults to C corporation treatment in New York unless the corporation makes its own separate New York S election. Therefore, in order to be an eligible New York S corporation, the entity would have to make or have had to have made a separate New York S election. An eligible partnership is any partnership, including a limited liability company, treated as a partnership for New York and federal income tax purposes that is a filing requirement under Section 658C1, and it is not a publicly traded partnership. Additionally, a partnership is eligible to make the election even if it has partners that are not eligible, such as corporate partners. Non-eligible entities include trust and estates, as well as single-member LLCs not treated as an S corp, sole proprietorships, nonprofits, and corporations that are not S corporations. Since single-member LLCs are not eligible, these entities may want to consider making an S election. And Harold or Tony, what are your thoughts on whether a single-member LLC may want to make the S election in order to take advantage of the New York pass-through entity tax?
Yeah, Harry, I think that would be potentially from a restructuring perspective might make sense. Tony, your thoughts?
I mean, I think that if the tax is paid at the entity level, again, it's not going to be limited in any way, or generally wouldn't be limited if it's coming through the partnership. You're always at risk for that limitation being limited on the Schedule A, as things currently stand.
Right. Interesting. So it's definitely a consideration. Okay. When does the election have to be made? The election must be made online, and it's made on an annual basis. Once the election is made for that specific year, it is irrevocable. And I think, as Tony previously indicated, the election for 2021 tax year is due on October 15th. So that's coming up pretty quickly. It's exactly 1 month from today.
Yep. One thing I want to say, though, Harry, on the because in reading through all of this and just reading that it's an irrevocable election, but it needs to be made annually, did not initially make too much sense to me. But then when we spoke through it, it's just, if you think about the way partnerships are, they have partners coming in. A lot of them have partners coming in and out at any given time. So it makes sense that it does need to be done annually, even though it is irrevocable, because you want that election to apply to any new partners that come in any given year.
Right, exactly. Okay.
I think the more difficult issue is going to be for years 2022 going forward, where the election needs to be made by March 15th of that year. So right now, making the election for 2021 by October 15th, you've got the benefit of knowing what your income is, at least for the first 9 months or 9.5 months of the year, whereas going forward, you're going to make the election by March 15th of that year. Obviously, you're going to need to have a little bit of a crystal ball to anticipate what your income will be for the year and whether it makes sense to move forward with the election or not.
Exactly.
Right. Yeah, that's a good point, Harold. So for calendar year filers, a calendar year basis has to be used to elect, file, and pay the pass-through entity tax. But for fiscal year filers, the entity elects, files, and pays the pass-through entity tax for the calendar year in which its fiscal year ends, which is obviously a little different than how the actual partnership return would be filed. If you're in a fiscal year, you would actually use the prior year's form. So as an example, if a partnership has a fiscal year ending February 28th, 2022, that partnership would need to make the election no later than March 15th of 2022 for the 2022 Ptet taxable year, because that's the year the partnership's fiscal year ends in the 2022 calendar year.
And there's no, Harry, there is no requirement to recompute the tax to effectively transition it into a calendar year tax. The tax is based on the fiscal year results for the year ending in that particular year. So you don't convert that to a calendar year amount as an example.
Right. That's a good point too. So how do you make the election? The election, I think, as Harold and Tony previously mentioned, must be made online. New York has set up a web page that provides a lot of good details on the New York pass-through entity tax, and it really walks you through making the election. The election is actually made via the entity's New York State Business Online Services account. So that is actually the same account that the entity would use to file its sales tax returns or make estimated payments of tax. And obviously, if you don't have an online services account set up, it's pretty easy to create one. The web page really walks you through everything. Can make the election, and I think it's important to note that New York has specifically indicated that tax professionals and pay firms may not make the election on behalf of their. So for a New York S corporation, any officer, manager, or shareholder of the New York S corporation who is authorized under the law of the state where the corporation is incorporated or under the S corporation's organizational documents to make the election, and who represents to having the authorization under penalty of perjury. That's the official definition that New York put out. And then for partnerships, it's any member, partner, owner, or other individual with authority to bind the entity or sign the returns. So probably, I would think, Harold, jump in, but the easiest way to probably think about it is, whomever they would make that election.
So perhaps like the tax matters partner as an example, or someone who signs the returns, or that sort of individual would be the person most likely to be the one making the election.
Right, exactly.
And again, let's double underline that your accounting firm, your legal advisors, or any other outside person cannot make this election on behalf of the taxpayer. It must be made by the taxpayer.
Right, exactly. Okay, so I think that takes us to our next polling question.
Thanks, Harry. So the third polling question of the webinar is up on your screen, and it reads, have you made pass-through entity tax elections in other states? Yes, no, not yet, but I plan to do so. Please make your selection now and be sure to click the Submit button to get credit for your answer. Just going to give it a few more seconds. Make sure you click Submit. Okay, let's take a look at the results. 57.1% of the audience said no.
Yeah, I mean, I guess that's, I don't know, Howard, what do you think? Not super surprising. I guess, you know, we have a large group of accountants, I think, on this webinar. You know, I don't know. What are your thoughts, Harold?
Well, yes, that, and I think also each of these pass-through entity taxes might have had some pluses and minuses to them. As an example, the New Jersey date. Under New Jersey law, a partnership is required to make non-resident withholding payments, and for some partnerships, that would clearly result in doubling up of payments on behalf of a non-resident partner, as an example. So there are some good and sundry reasons why some of these pass-through entity taxes perhaps were not elected, and some of the larger states had not weighed in on this until more recently. So with New York, Illinois, and California being new to the game, I would imagine that we see a market increase in the number of states, and for that matter, number of taxpayers electing these pass-through entity taxes. So the next section, we're going to get into a bit of the nitty-gritty as to how payments, when payments can be remitted, and the actual tax computation for a partnership and an S corporation. So just to reiterate what was discussed earlier, there's no requirement for a pass-through entity to make any estimated taxes for the PTET for 2021. However, a pass-through entity can elect to make a payment on or before December 31 of this year, and the state has indicated that they will provide some online link for taxpayers to make the payment somewhere in the December 15th timeframe, so that a payment could be made between the 15th and 21st. Clearly, this is really an important factor, because for both, on the federal law, for both cash and accrual basis taxpayers, the payment needs to be made in the calendar year that the deduction is going to be claimed. The other provision that is sort of interesting is that New York State in its legislation requires that members of pass-through entities that are making the election must still make their own personal estimated tax payments as if the election was not made. So if you're a partner or a shareholder in an entity that makes the election, you still have to make your own personal quarterly estimated tax payments as if that PTET election was not in place, and the state has indicated that any members of a pass-through entity that fail to make the quarterly payments will be subject to underestimated tax penalties for failure to make their own quarterly estimated payments. For PTET years beginning on or after 1/1 of 2022, as Tony indicated earlier, the quarterly estimated payments will be required. So there is a big difference between the way partnerships and S corporations compute the PTET. The first step for partnerships is that they will be required to classify all direct members or partners as either a resident or non-resident of New York, so they'll have to determine the resident status of each member of the partnerships. A member can't be classified as a part-year resident for PTET purposes. So basically, a partner who resides in New York for at least half the year will be deemed to be a resident of New York for purposes of the PTET calculation. All other members are non-residents. It should be noted that if the member or partner is a trust, basically the residency status is based on the residency of the trust, not on the resident status of the beneficiary. So if it's a resident trust in New York, then it's a resident for purposes of the PTE tax calculation. So why is this residency determination so important? In a nutshell, it's important because in calculating the PTET, a partnership is going to take all items of income, gain, and deduction that are allocated to a resident individual, regardless of where the income is earned. So even if the pass-through partnership has income earned in other jurisdictions because it's a multi-state partnership, if the partner is a resident of New York, 100% of the distributor's share is included in the PTET calculation, whereas for non-residents, it's only, the PTET is calculated only on their New York source income using New York's three-factor formula partnership business allocation as reflected on the IT-204 filed by the partnership. So in a nutshell, what happens is you aggregate the total of the distributor shares of all resident partners and the New York source income of all non-resident partners. The total of that aggregation is the amount of PTET that is PTET income subject to the PTET tax. For electing S corporations, however, I'm sorry?
And so, Harold, just
Tony,
to pause right there have been a few questions on the residency issue. And, you know, if you want one up, which I think is a great question, is if you have a partnership with, let's say, New York and Florida residents, how is that PTET paid out, and how does it get creditable to the partners? So would the Florida partners be eliminated from that credit and it just gets allocated directly to the New York partners?
So the answer to that is the Florida partner is going to get his or her share of the PTET based on the New York source income of the partnership that theoretically that non-resident partner is going to be reporting on their non-resident IT-203 for New York State purposes. So again, it's the aggregate of 100% of the income ascribable to resident partners and the New York source income of the non-resident partners.
Okay, great.
With respect to S corporations aggregate all items of income, gain, loss, or deduction, but essentially here it's based on the New York source income of the S corporation. It is not based on the resident status of the shareholders of the S corporation. So effectively, the S corporation determines its New York source income based on corporate apportionment rules, which is single sales factor and market-based / customer-based apportionment for the single sales factor. So you can see there's a big difference between partnerships, which pay the tax based on 100% of resident distributor shares and only New York source for the non-residents, and S corps that can only pay based on the actual New York source income of the S corporation. The Ptet tax rates vary from as low as 6.85% on Ptet taxable income of $2 million, and then there's a sliding scale all the way up to Ptet taxable income of greater than $25 million, which is taxed at a 10.9% rate. So what happens with respect to the Ptet credit when it comes to the individual partners and shareholders? First of all, the credit is equal to the direct share of the Ptet that was reported by the electing entity. So each taxpayer, being a partner or a shareholder, will receive 100% credit for whatever Ptet was calculated on their behalf. If the amount of the Ptet credit allowable for the taxable year exceeds the taxpayer's tax due for the year, the excess will be treated as an overpayment to be credited or refunded. So by way of explanation, what that means is that if the pass-through entity remits payment, let's make this up, of $100,000 on December 15th of 2021, they file their Ptet return on or after March 15th of 2022, and the actual liability for Ptet is $60,000, so there is a $40,000 refund. The $40,000 refund is refunded to the partnership. It is not refunded. It's not credited to the individual taxpayers. It is refunded to the partnership. So a partnership or an S corporation can't overpay the Ptet in an effort to give a larger credit to the individuals. That overpayment would be claimed and reported by the pass-through entity. Another important issue is for taxpayers that have elected in the past to file on a composite basis for their non-resident partners for New York. So New York has said that the Ptet credit has to be claimed on an individual personal income tax return. The Ptet credit cannot be claimed on the Form IT-203-GR, which is the composite group return for non-resident partners. For non-resident partners who made those elections in the past as a matter of convenience to enable them to avoid filing their own personal income tax return, might choose to instead just file their own return and ostensibly not join in a composite return for 2021 forward. It's also important to note that for New York State purposes, that the Ptet credit is an addition modification to federal AGI or federal taxable income, so that effectively New York is not allowing a deduction not only for the Ptet, but also for any other pass-through entity taxes that might be incurred for any other state. Finally, with respect to resident credits, good news is that for tax years beginning on or after 1/1 of 21, New York resident partners, members, or shareholders will be allowed a resident credit against their New York personal income tax return for pass-through entity taxes imposed by any other state, local government, or DC that is substantially similar to the PTET. The legislation has not, at this point, defined what substantially similar to the PTET is. Right now, however, New York has indicated that they will publish a list of the other state taxes that meet that definition of substantially similar with respect to the resident credit. Finally, I think just an observation that most states that have enacted pass-through entity taxes have also enacted provisions allowing resident credits for other state pass-through entity taxes. So specifically, I can tell you that New Jersey, Connecticut, California, as examples, have all indicated that they will allow a resident credit for pass-through entity taxes imposed by other states. And that's an important consideration, clearly, with respect to making these elections, because there's always a possibility that if a partner or shareholder resides in a state that does not have a pass-through entity tax, that there is ostensibly no guarantee that that state will allow resident credit for the pass-through entity taxes that are paid and ascribable to that owner. So right now, back to Sean for our final polling question. Sean?
Thanks, Harold. So the final polling question of the webinar is up on your screen, and it reads, the PTET election for 2021 is due on what date? December 31st, 2021, October 15th, 2021, March 15th, 2022, or April 15th, 2022. Please make your selection now and be sure to click the submit button to get credit for your answer. We'll give it just a few more seconds. Make sure you click submit. Okay, let's take a look at the results. So 84.6% of the audience at October 15th, 2021.
Which is the correct answer. As a reminder, for 2021, the election is due in 30 days, as Harry had emphasized earlier. For tax year 2022, the correct answer would be March 15th of 2022. And for each succeeding year, an annual election must be made by March 15th of that year. So on to the final segment, which is what factors or issues should be considered with respect to making the New York PTET election. The first one is one I alluded to earlier. So based on New York's legislation, where the owners of the pass-through entity are required to make their usual estimated tax payments, and then the PTET credit is also going to come into play. That certainly may result in overpayments, perhaps even substantial overpayments for certain taxpayers. and if you view it from a certain perspective, if the PTET is made December 15th of 2021 or at any time before the end of the year, if one of the owners or any of the owners don't file their 2021 tax return until the full extended due date of October 15th of 2022, by the time New York State actually processes that overpayment, you could be talking about up to a year or maybe even more than a year that there would be perhaps a interest-free loan that New York State is enjoying for 2021. That issue goes away for 2022. Next issue is, as I mentioned, the tax rate is computed on the aggregate income of the pass-through entity. It's not based on each individual owner's tax situation. So, as noted, the rates can be as high as 10.9%, and depending on the individual tax situation of the owner, certain owners may be in a much lower tax bracket than 10.9% for New York purposes, especially, let's say, less senior partners or owners that own a much smaller share of the partnership conceivably could be in a lower tax bracket, and that might result in a much higher payment that will ultimately be refunded to them. The next issue with respect to overpayments, I'd like to have Tony weigh in on this one, is that essentially there's a question as to how is the IRS going to view these types of overpayments. So specifically, where a taxpayer files a 2021 return for New York and there's an overpayment, what is it that the overpayment is going to be ascribed to? Will it be ascribed to the individual's personal estimated tax payments for which no tax benefit was received and conceivably, therefore, would not be taxable for federal purposes? Or alternatively, could it be that the overpayment is ascribed to the PTET credit, which arguably the taxpayer is receiving a benefit of that deduction because that deduction was netted against the ordinary income shown on the K-1? Or is there some hybrid approach? Tony, what's your opinion?
Yeah, so I mean, we talked about this a little bit before the call, but one of the questions that came in, I want to loop it into this question because I think it's related, is that, you know, what's the downside to the PTET tax? And I think what it comes down to is that there is a certain level of complication with paying this type of tax, especially when you have a partnership that has, you know, partners that come in and come out during the year. And it really needs to be traced what is paid on behalf of each partner and related to their income to what, if there was an overpayment, how it gets credited back to that partner, applied back to that partner, I should say. So it's you know, not only is the partnership now required to file an additional return and to, you know, have additional deadlines and additional payments and, you know, additional accounting fees for all of this work, there has to be a accountability for who these payments were made on behalf of. And when refunds are brought back to the entity, how they get applied back to the partners who they relate to. So that's the complication with the whole thing. You know, certainly if you have a partnership that is, you know, you have the same partners year over year, it's not as difficult, but you still have to keep track of how these payments are made on behalf of whom and how they get allocated back. Even if you have the same partners in a partnership, their allocation percentages could change year over year. And so then the payments that are made on their behalf are going to change year over year. And if there are refunds coming back, that will affect that. In addition, one other point that I talked to Harold about before the call was that, if you are a partner in a partnership and that partnership is making payments on your behalf and you file a joint return with your spouse, the partnership is only basing their payments on your income based on your income, not including your spouse's. So that you may be in one bracket individually, but when you file your joint return, you could be pushed into a different income bracket, which then creates a different liability for you, at the individual level. So, there are complications to consider, with regard to the Ptet tax. It's not, it's not 100%, the best way everybody should go, but, these are just some things that need to be considered.
And Tony, the final point is, can investment partnerships claim a deduction for the Ptet on page 1 of their 1065?
That's a great question. I didn't even really contemplate that before the call. I don't want to answer that without...
Right. It's a hypothetical that I think is a little uncertain, and ostensibly a non-resident in an investment partnership also has no New York source income, so clearly a non-resident would probably not receive any benefit. I wanted to quickly shift over to the Q&A, and let's see if we, in the last 3.5 minutes or so, have time to answer at least some of the questions. One question was, does a pass-through entity have to be generating a profit to file the election? The answer is, well, there's not going to be any benefit if there's no profit. So at this point, let's say if there is any uncertainty as to whether for the full year an entity is going to have a profit or not, they should probably make the election, but there's no benefit to be had since the pass-through entity tax is based on the profits of the pass-through entity. Question is, if a partnership has a New Jersey partner, can this apply to the New Jersey partner? The answer is yes. However, again, the benefit is based on the New York source income ascribable to that partner, not on the total income of that partner. I think we covered where and when you can make the election and the fact that an accountant cannot make the election. Question was, does the non-resident partner or member get dollar for dollar benefit? The answer is yes. It's 100% credit that is passed through.
Right. So again, back to the point that the partnership income comes up to the 1040 on a Schedule E, and that is one number that does not get included on as an itemized deduction as previously, which would have been limited.
All right. Here's a question. If your partnership has income of, say, $1 million, so let's say $100,000 is the income tax that would be due. However, if the partners have income outside the partnership of another $2 million, could the partnership pay $300,000? The answer is no, that the partnership can only pay on the Ptet taxable income generated through the partnership. Question is, does New York City UBT fall under Ptet? No, it does not. That's an entity level tax imposed by New York City. A question, is the signed election for each partner in a partnership different for an equity partner versus an income partner? The answer is no, that guaranteed payments are included in the calculation of the Ptet. So effectively, the election is the same for both. Question is, if my S corporation has a November 30th fiscal year end, can I take advantage of this for the current year, or do I have to wait until my subsequent tax year beginning December 1, 2021. So again, the PTET is a calendar year tax which is based on the fiscal year ending in that calendar year. So if your S corporation has a fiscal year ended November 30th of 2021, you can elect for 2021, and the election is due October 15th to make the PTET election. Question is, if an S corporation usually pays salaries to an S corp shareholder, has its effective PTET income, and IRS saying no PTET? Well, if an S corporation is paying out its income in salaries and zeroing out its income, then clearly it's not going to have any PTET taxable income. So that might be something that an S corp might want to revisit as to whether they want to pay out all of that income in the form of salaries. Just to reiterate, the rates for PTET are on an aggregate, not per partner. It is based on the aggregate income of all the partners. And I think that probably covers most of the questions that were answered. Clearly, any of the participants in today's webinar will be happy to answer any of your other questions. So just to summarize, before I turn it back to Sean, this is clearly a possibly significant benefit that owners of pass-through entities can enjoy by making the pass-through entity tax election. None of us have a crystal ball as to whether there will be any change in the SALT limitation or not. And for that matter, if there is, what the effective date would be. So please keep in mind, October 15th is the drop dead due date with respect to making the PTET election. We really appreciate everyone joining us. Sean, back to you.
Thank you, Harold. We hope everyone enjoyed today's webinar. Thank you to all of our speakers. If you've completed the CPE requirements, your certificate is now available for download. You'll see the instructions on the screen now. If you're a Mazars employee, no need to download the certificate. We also encourage you to tell us what you thought about today's webinar by completing our feedback form, the link to which you will see on the screen shortly. Please take a minute and click that link once we conclude here. Feel free to reach out to any of today's presenters or myself with any further questions. Thank you once again, and enjoy the rest of your day. Stay well, everyone.